Welcome to Money Chat, the place to get information on money, personal finance and budgeting. Housing market. Analyzing the U.S. housing market, exploring mortgage rates, interest rates, and how to prepare for a crash. The U.S. housing market is an ever-changing landscape, with prices fluctuating depending on factors such as mortgage and interest rates. With the recent economic downturn, it is more important than ever to be prepared for a housing market crash. To do this, we need to understand how mortgage rates, interest rates, and other factors affect the housing market. Money Chat will provide an in-depth look at the U.S. housing market, exploring mortgage rates, interest rates, and what steps to take to prepare for a crash. We will be giving you tips for first-time home buyers, so keep listening. In addition, Money Chat will examine past market trends to understand the current market better, and discuss ways to protect your investments in case the market suddenly turns. Ultimately, this article will give you the knowledge you need to make informed decisions in the U.S. housing market. Overview of the U.S. housing market. The U.S. housing market is an economic sector that includes activities related to selling, construction, financing, and insurance of real estate. Real estate is essential to the U.S. economy, from selling raw land to funding construction. As of 2017, the U.S. housing market was worth $37.8 trillion, which amounts to about 35% of the American economy. The housing market has gone through many different cycles in its history. However, it has always been cyclical, meaning it has gone through periods of growth, slow growth, and decline. The housing market has been especially volatile in the last decade due to several factors, including mortgage rates, interest rates, supply and demand, and economic uncertainty. Each of these factors plays a different role in the market's health and can affect the housing market differently. This article will provide an in-depth look at each of these factors to understand the housing market better. Factors influencing U.S. housing market. Mortgage rates are the interest rates associated with the rates of new mortgages. They determine the number of money homebuyers needs to pay on their mortgages. Lenders are more likely to offer lower mortgage rates when the housing market is growing. When the housing market grows due to a higher demand for mortgages, and a larger supply of money to lend. When the housing market is weak, lenders are more likely to charge higher mortgage rates, due to lower demand for mortgages and a smaller supply of money to lend. Mortgage rates are among the most significant factors influencing the housing market's health. When they are low, more people can afford homes, thus increasing demand and spurring investment. However, fewer people can afford homes when high, decreasing order and decreasing investment. Interest rates are the amount lenders charge to cover the cost of loaning money. When the interest rates are low, it is cheaper to borrow money, resulting in more people taking out loans and increasing the demand for mortgages. It also increases the money supply to lend by encouraging banks to access lower-cost capital. When the interest rates are high, it is more expensive to borrow money, resulting in fewer people taking out loans and decreasing the demand for mortgages. It also lowers the money supply to lend by discouraging banks from accessing lower-cost capital. As a result, interest rates are among the most critical factors influencing the housing market's health. When the housing market is booming, interest rates are generally low, spurring demand and investment in the housing market. However, when the housing market is weak, interest rates are usually high, decreasing demand and investment in the market. Supply and demand. The housing market is cyclical and can experience periods of growth and decline based on supply and demand. When the supply is more significant than the demand, this is an excess supply and can decrease prices. It occurs when more houses are on the market than buyers, resulting in a decrease in price due to a lack of demand. But, again, many factors can cause it, most commonly attributed to interest rate changes. When interest rates are low, more people can afford mortgages, spurring demand for housing and driving up prices. When interest rates are high, fewer people can afford mortgages, decreasing demand for housing and driving prices down. When the need is more significant than the supply, this is an excess demand and can increase costs. It occurs when there are fewer houses on the market than buyers, resulting in an increase in price due to a lack of supply. It can cause various factors, but is most commonly attributed to changes in mortgage rates. When interest rates are low, more people can afford mortgages, increasing demand for housing and driving up prices. Analyzing past market trends. The housing market has seen many ups and downs throughout its history. Still, it has always bounced back to equilibrium at some point. The economic recession of 2001 is attributed to the dot-com bubble that burst during the late 1990s. The housing bubble in 2008 is attributed to the subprime mortgage crisis. People who were unlikely to get approved for a mortgage were still getting approved. The economic recession of the late 2000s and early 2010s is attributed to the weak housing market and other economic factors discussed below. Many signs can indicate an upcoming crash in the housing market. One of the most important things to look out for is a change in the average mortgage interest rates. When rates suddenly rise, this often indicates that the housing market is beginning to slow down. While these are good indicators to watch out for, remember that they are only sometimes correct. Many other factors can affect the housing market. Preparing for a potential market crash. You can take many steps to protect yourself from a potential market crash. The best thing you can do is diversify your investments. When you invest in a single asset, it is essential to diversify your investments to protect yourself from potential risk. However, when you diversify your investments, you spread your money into several different areas. This way, if one of your investments do poorly, the others may be able to make up for it. Another thing you can do is conduct research on the economic factors affecting the housing market. It will enable you to better understand and predict how factors like interest rates and supply and demand may affect the market in the future. Economic uncertainty is difficult to predict, but a better understanding of the factors influencing it can be very beneficial when preparing for a crash. First-time home buyers. Buying a home is an exciting but potentially overwhelming process. Mortgage rates, housing market rates, and first-time home buyers are factors to consider in the decision-making process. Mortgage rates are at an all-time high right now, making it a bad time to purchase a property. However, with low mortgage rates, the monthly mortgage payment can be more than renting. It's essential to research mortgage options and compare different mortgage rates from various lenders before settling on one. The housing market is also in flux due to recent economic changes. It can affect your decision on whether or not you want to buy a property. Prices may have gone up significantly since last year, or there may be more competition for homes in the area. For first-time home buyers, there are many programs and incentives to consider when deciding on a mortgage. Exploring your options thoroughly and ensuring you understand the mortgage terms is essential before signing any documents. When doing your due diligence and researching mortgage rates, housing market rates, and first-time home buyer incentives, you'll be more confident as you embark on this exciting journey. Tips for first-time home buyers. For first-time home buyers, the housing market can be an intimidating world to navigate. With so many factors to consider, it's essential to research and understand what you need to know before taking the plunge into homeownership. Whether you are looking for a starter home or something that will be your forever home, following these tips can help make the process less overwhelming. 1. Research the housing market. Before committing to buying a house, it's essential to get a good understanding of the current housing market in your area. Research prices of similar homes in your area. Housing trends in appreciation, depreciation, and any other information that could impact your purchase decision. 2. Consider affordability. It would be best if you were realistic about how much house you can afford. Speak with a financial advisor or loan officer and calculate your debt-to-income ratio, and the cost of mortgage payments, taxes, insurance, and other related expenses. 3. Get pre-approved. Once you know what type of home you can afford, it's time to get pre-approved for a mortgage loan. It will give you an idea of the range you should consider when shopping for a home. 4. Shop around. Don't just settle on the first house that catches your eye. Instead, take some time to look at multiple listings and compare them to find the best fit for your needs and budget. 5. Make an offer. Make an offer when you have found a house that fits your needs. Be aware of any contingencies included in the purchase agreement, and negotiate until you can reach a mutually beneficial agreement. Following these tips can help first-time home buyers make well-informed decisions when navigating the housing market. Doing research, considering affordability, getting pre-approved for a loan, shopping around for different listings, and making an offer will all be critical components. With patience and careful planning, first-time home buyers can find themselves with keys to their dream homes in no time. The U.S. housing market is an ever-changing landscape, with prices fluctuating depending on factors such as mortgage and interest rates. With the recent economic downturn, it is more important than ever to be prepared for a housing market crash. To do this, we need to understand how mortgage rates, interest rates, and other factors affect the housing market. Money Chat will continue to provide an in-depth look at the U.S. housing market, exploring mortgage rates, interest rates, and what steps to take to prepare for a crash. In addition, we will examine past market trends to understand the current market better and discuss ways to protect your investments in case the market suddenly turns. Ultimately, Money Chat will give you the knowledge you need to make informed decisions in the U.S. housing market. To stay informed on the housing market, please hit the subscribe button to get the latest from Money Chat.